Hi, everyone. I'm Rhonda Huismann with Crowe, and I'm the chair of the CFMA Tax and Legislative Affairs Committee. And I am back again today with Jeff Kummer from Deloitte's National Tax Office in Washington, D.C. Hi, Jeff.
Afternoon. How are you doing, Rhonda?
Good. It's been a little over a week, I think, since we last spoke. Your last week was a busy one for you.
Yes, it was, as a matter of fact. And I think there's two developments that we'll talk about here this afternoon over the next couple of minutes. And the first one is really finalizing something that really goes back to early August, and that is President Biden on Monday, November 15th, signed into law that bipartisan legislation that provides for an investment of roughly $550 billion in new spending over the next 5 years. Total of about $1 trillion overall number, but 550 of that is sort of new investments in so-called hard infrastructure projects. This is the Infrastructure Innovation and Jobs Act, the bipartisan highway bill that we've talked about on our previous podcast. So that is now law. It does not have much tax really involved in it, but there are a handful of tax-related items in there. One of them is, as for folks that are focusing on digital assets, interestingly enough, there is an information reporting provision in there. So beginning in a couple of years, you'll have to deal with 1099s related to the reporting of digital assets and cryptocurrencies. The one I think, Rhonda, that, then the second one I would touch on real briefly is there is a reinstatement and a modification to the old expired Superfund excise taxes on the production of certain chemicals through December 31st of 2031. So that is going back to the mid 90s, those old Superfund excise taxes on oil and imported oil and chemicals, and reinstating just the chemical one for the next 10 years or so. So that is in there as well. And then one that's been generating, I think, some interest is related to the employee retention tax credit. And that's basically they sunset 3 months ahead of its scheduled expiration date, that retention tax credit. So instead of taxpayers being able to avail themselves of that credit through the end of this year, the credit and the qualifying for that credit effectively ended on September 30th of 2021. So I think Congress looked at that and decided that maybe not a lot of employers were really taking advantage of that. Maybe it wasn't as popular as other tax provisions that had been enacted as part of COVID relief legislation over the last 20 months or so. And they were looking for some limited revenue sources in order to finance some portions of this highway bill. And so tax writers looked to just simply accelerate that tax credit by 3 months as a way to raise revenue. So the infrastructure legislation is now law. That Infrastructure Innovation Act is now law, and so we can anticipate some of those projects beginning to get started, states beginning to receive some of those funds so that they can start to begin those projects. Granted, it will take a little while for that to happen, but nothing was going to get going until the president signed it, and the House had passed it on November 5th, and that cleared him to sign it on November 15th.
Yeah, no, I think that's the good side is that infrastructure. It certainly will bring a lot of work to the construction industry. I think, some are curious in terms of the industry that's already heavy laden with a lot of work, and I think a lot of backlog and how all the work will get done. But that's definitely a good thing to see that, that coming into play. I do want to dig a little bit deeper on the employee retention tax credit, and a couple things. It's interesting because I feel like it's been a bit of a sleeper. A lot of the construction companies did get PPP loans, and I think that with the original rules prohibiting you from taking both, it seems like a lot of contractors that I've spoken to didn't realize until even the last few months that they were eligible to look at that. And many that I know had just started looking at that and digging in a little bit deeper and going through and amending those. So I feel like, maybe it was a better benefit than what was estimated there. I have heard some talk there might be some pushback in terms of trying to get that reinstated for fourth quarter, and maybe some contractors that are hopeful that there might be some action taken there. I guess, can you speak to that? And also with it, the scoring system, just at a very high level to help people understand, well, wait wait a minute, how does this really generate revenue? What does that mean? Maybe
Sure. Yeah.
what both of those items might look like.
Sure. And you do raise a good point, Rhonda, which is there are some groups that have started to circulate on Capitol Hill talking points to the effect that it would be beneficial, actually, if they had that fourth quarter of this year in order to qualify those activities for purposes of that credit. And so there's starting to be some discussion around that. And to your question around revenue estimating, this is sort of one of those interesting things in Washington. What you have is a tax relief provision which costs Treasury money in the form of the retention tax credit. But then, because it was scheduled under current law to expire at the end of this year on December 31st, by accelerating that expiration date, it can be scored as actually raising revenue for Treasury on a revenue estimate sheet. But then, if you add that 3 months back, then it would be scored as losing revenue, and then you would have to find the revenue, in theory, to pay for that amount of money that is scheduled to be raised during this 3-month period of time. So it's an interesting sort of number counting exercise for policy purposes. Mechanically, what would have to happen is they either would, supporters would on Capitol Hill would either have to introduce new legislation, which would go back and amend the Infrastructure Act in order to reinstate that 3-month period, or they could put it into other legislation that is germane, that has a revenue title, which I think kind of then brings us to our second development for today, which is that the House on Friday, finally, we've been watching this play out now for the last couple of months, but finally passed the Build Back Better Act legislation. This is the tax and spending legislation that congressional Democrats have been working on for the last couple of months. And it involves tax increases, certainly, and has been the subject of, I think, a couple of our previous podcasts that we've done. But the House has now approved that, and that now clears it for the Senate to take up once they return from the Thanksgiving holiday. Obviously, the House and Senate are out this week, so they're not coming back until next week. And so that's sort of clearing us and setting us up for what could be potentially a busy December as the Senate starts to take that House-approved legislation. They're going to make changes to it. And this has been, just to kind of, again, backstep for a moment to think about where we've come over the last couple of months. This is using budget reconciliation. So this is Democrats moving this tax and spending package, this Build Back Better Act legislation, on a single party vote where they only need a simple majority, 50 votes, plus the vice president as a tiebreaker in the Senate, rather than the typical 60 votes that you usually need in order to vote on legislation on the Senate floor. It's really been a vexing set of questions for congressional Democrats to answer amongst themselves, given that there's been a number of tensions within that Democratic Party. And the core questions have been, how much do you spend? Is it like $3.5 trillion, which is where House Democrats were back in September? Is it closer to $1.5 trillion, which is as a top line spending number, which is where Senator Manchin from West Virginia has said a number of times publicly he is at, or is it somewhere in between? And as you then decide on what that number that you want to spend up to is, then you can determine what programs that congressional Democrats want to spend that money on, and how long should those programs be in place for. And then once you determine that, the question becomes how you pay for it. What revenues do you look to finance a significant portion of this, and how much revenue do you ultimately need? And that's kind of led us, those sort of questions have kind of led us to the point where we are today, which is a $1.75 trillion spending package approved by the House. It was a 220 to 213 vote. Jared Golden, a Democrat from Maine, voted against it. Is the only Democrat to vote against it. No Republicans voted for it. And it passed the House, which is something they've been working on now for a long time. But it's over in the Senate. And as I mentioned, we're going to see a number of things get changed. And it's going to be in kind of two forms. The first thing that's going to happen is, and literally this week, the Senate parliamentarian is beginning to go through every provision in that House-approved legislation to scrub it for germaneness purposes, right? So the Senate has a unique set of rules that relate directly to this process of budget reconciliation, referred to as Byrd rules, and those limit what can and cannot be considered under budget reconciliation. So she goes through every provision, and she may see provisions that don't meet those germaneness rules, and then they're stricken. So you're going to expect to see some changes in this House passed legislation simply because the parliamentarian is going to excise those from the legislation. So a lot of discussion around immigration law changes, for example, those probably won't pass muster. We don't see it as much on the tax side, because one of the key definitions for budget reconciliation is that every provision must either, it must affect Treasury receipts in some way, right? So it must either raise revenue or lose revenue. Tax increases raise revenue, tax cuts lose revenue. So tax isn't really as affected by these rules, but other policy changes and other program changes potentially are. Then that kind of brings us to the second point, which is the Senate has a little bit different makeup than House Democrats. Democrats in the House do. It's 50-50, as we know. And that means every single one of those Democratic senators has leverage that they can exert over this process. And we already know, for example, Senator Manchin has some concerns with some of the spending programs. He has concerns with some of the provisions in the green energy space, the tax incentives in the green energy space. You have other senators who are concerned about the type of relief from the $10,000 state and local tax deduction cap that is in the law today. House Democrats put into their version an $80,000 cap, but Senate Democrats are arguing that it should be more of an AGI threshold. So you either get below a certain AGI threshold, there would be no $10,000 household limitation on state and local taxes as a deduction. But anything above that AGI threshold, then you would see that $10,000 haircut remain in place. So there's differing views on certain things. There's other things that are going to be taken out, and all of this layers into a very busy December. Government funding still has to be addressed. Right now, the federal government will shutter its windows and doors at 12:01 a.m. December 4th, because funding expires on December 3rd. I anticipate that will get extended, but it may only be for a brief period of time. They're talking about maybe only a couple of weeks. So just kind of pushing it off while they try to finalize the numbers to authorize spending for government departments and agencies. There's also the debt ceiling that will have to be dealt with, that borrowing authority, that amount that Treasury can effectively borrow up to, besides otherwise, in other words, or they will default potentially on their borrowing obligations as a federal government. So that is a politically challenging issue to deal with as well. And then there's working through this Build Back Better Act legislation. I think Senator Schumer, as the majority leader in the Senate, is hoping that they can get it passed by Christmas and have it all done this year. But there are still, again, a few more hurdles that will have to be overcome timing-wise, as well as process-wise before this is concluded. And so we'll see. But it's, I think, setting us up for what's going to be a very busy December potentially.
Yeah, absolutely. I guess in addition, from what the House passed, in addition to the state tax cap, any other noteworthy tax items in there?
Yes. Yeah. I'm sorry, Rhonda, I didn't mean to cut you off there, but very good point. So on the business side, there's more that are more of the large corporate entity type provisions. So you have this new corporate min tax that's based on book income and adjusted financial statement income concept. There is a 1% excise tax on stock repurchases. So a corporate entity buys back its own stock, it's going to pay 1% on the amount of that, the value of that stock repurchase in a taxable year. That's effective in 2022. There's a lot of international changes, again, multinationals with how they structure their operations and where they have their supply chain and their operations. There's provisions that are potentially going to impact them there. On the individual side, there's a surcharge that really kicks in for upper income individuals. So once you hit $10 million, you're going to pay an additional 5% tax on every dollar of income above that. And that income could be wages, it could be capital gain income, it could be distributions from an IRA. Doesn't really matter the character of the income. You're going to pay all of your current taxes on that. Then once you get to $10 million, it's another 5% on top of that. And then once you get to $25 million, another 3% on top of that. So granted, this is a very upper income impacting provision. But there is also a change to net investment income tax. So right now, depending on certain trade or business activities, you may not pay either self-employment tax or net investment income tax, that 3.8% tax. That this is going to ensure that everybody pays at least the net investment income tax going forward. So that may impact folks, again, depending on the character of that trade or business activity that they have. There is also a change to a provision related to excess business loss limitations. And it does really two things. It extends the current limitation permanently, makes it permanent beyond 2026, which is the current sunset for this provision. But the other thing that it does is it really makes it more difficult if you have excess business losses, kind of rolling them forward into future years. It changes the treatment of those, and that begins as early as 2021. So excess business losses generated this year are more difficult to sort of use in future years, and that just kind of continues to roll on as the years go by. So there's definitely tax increases in there, and then on the clean energy side for incentives, a lot in there, related to clean technologies and clean energy. It's more traditional things: production tax credit for wind and solar, investment tax credit, placed in service dates being extended. But it's also a lot around electric vehicle purchases. There's EV recharging station incentives. There's manufacturing incentives. There's over $200 billion worth of tax incentives in the green energy space. So a lot there: commercial building incentives, residential energy incentives. So things around construction, in terms of installing solar and things like that. So there's a lot in there on the energy side, on the incentive side. But this is really more about using taxes to offset spending programs that are folded into this as well. So more on the tax increase side is where we're seeing, I think, the discussion.
Right. Well, I think a few calls ago, you predicted the creativity that's then needed when you can't just across the board increase rates, right? So that's right. What we're seeing here for sure. And the net investment income tax and the losses, those are probably two big ones on the increase side for people to be aware of, particularly that 3.8. I think a lot of contractors probably will be in that boat, but it's nice to know that there are those credits they can take advantage of with the green credits that are there too, with the energy efficient credits. So, well, good. I guess what you anticipate? I guess you already laid that out a little bit. You anticipate seeing some activity here after Thanksgiving break, and I guess any final thoughts as we wrap things up here for the call today?
Yeah, it's interesting. This is by no means set in stone. It's not a guarantee. There's still a potential that this whole process does kind of grind to a halt. Just over the differences that particularly now in the Senate, some of the concerns that some of the more moderate Democratic senators have, as well as even some of the more progressive Democratic senators related to the SALT cap, for example. So this is not finished. It's going to have to go through a lot more hoops before we see a final product. But I still think that the odds are still a little higher than 50%. I think that something gets signed into law. I know they're pressuring to get it done by year end instead of letting it layer over into next year. The longer it drags out, the more opportunity there is to see this fall apart potentially, or to poke holes in it, if you will. So I think they're going to try to get this finalized in December. But gosh, that means December 24th, Christmas Eve, is a Friday. December 31st is a Friday. And I'm not saying I want Congress here working on this necessarily, but I do see, based on history, Congress sometimes needs action forcing events in order to push them over the edge on something. And so maybe it's that Christmas Eve Friday, and they're wanting to go home and they want to spend time back in their districts and their states, their families over the holidays. And maybe that's the thing that gets them across the finish line. But I think there's going to be a few ups and downs the first 2 weeks of December before we get there.
Yeah, absolutely. And it'll be interesting to see which senators to watch and which ones come forward with different ideas on things here. But well, thank you, Jeff. This was helpful. And for all our members, thank you for tuning in, and happy Thanksgiving to you all. And we will be back with you, I would imagine, the week after Thanksgiving. Wouldn't you think, Jeff?
It's quite possible. We can have some things to talk about.
All right. Very good. Thank you.